I'm 22 or 24. It's really hard to decide and know.
At the end of the day, just keep buying.
Yeah. Oh my God, Brandy, I'll send you $20 after the show. Okay.
Welcome back to the Crossroads, a weekly financial show for our generation. And for the listeners, welcome back to the Long Game Podcast. This week, we are joined by Nick Maggiulli, who was kind enough, or maybe just smart enough to put his last name pronunciation in his Twitter bio. So I appreciate that. But he is the Chief Operating Officer at Ritholtz Wealth, which is one of the largest financial planning firms in the country. He's been writing for his Of Dollars and Data blog since 2017, which features like weekly posts about all things investing, data, personal finance, which kind of leads us into what we're going to be talking about in today's episode, which is his new book set to come out next Tuesday, which is called Just Keep Buying: Proven Ways to Save Money and Build Your Wealth. So you've obviously got a lot going on, and looks like you're on a little podcast book tour right now. So we appreciate you making a stop here and taking the time to chat with us.
Of course, anytime. I'm very excited for this. I know you guys are really into this type of stuff, so it's good questions. So
of course.
Before we get into it, let's hear a little bit about what your role is like at Ritholtz. Like, I think like everybody in the financial services industry is like knows of them. It's like probably the most popular firm, but like, is most of your job really creating content writing?
No, that's actually that's completely a side hustle. All of that's like my own thing. I don't really do it on firm time. But for what I do at Ritholtz, I'm like the chief operating officer, but I started as a data scientist. And so basically what I do is I just try and, organize information so we can make better business decisions. That's called business intelligence. But I started doing that, and I started doing a bunch of other stuff at the firm. So whether that's like managing the firm's websites, right? Making sure leads are coming and things like that, seeing how the lead process is going through, managing all of the workflows in Salesforce. So our operations team can actually, do their jobs, open accounts, trade the accounts, invest them, all that type of stuff. So there's a lot of my role there is actually very ops based, and I've never really written about it, but it's like completely different than like all the investment advice stuff or the investment writing I do. So it's mostly operations based.
That's interesting. I would have guessed it would have been like kind of a part of the job.
Not really. It's kind of different. So I have my data stuff I do, which is good and helps me kind of keep my chops up. And then I do the writing, which is separate. So, I mean, obviously like remember my blog was started before I was at Ritholtz, and then I joined with them because they're all there's like bloggers too. But like, for example, Michael Batnick, my boss, writes the Irrelevant Investor. So he writes too, but he also has he does a lot of stuff at the firm besides just doing content. Like that's a big piece of his job, but he does a lot of stuff on the back end for, in the investment committee for making sure the firm's running and everything's a managing partner. So there's a lot more than what you guys see is just like the content side. But yeah, there's like the whole running of the firm, which is like a full-time job for me, so.
Yeah. And before we dive into the book and all the questions we've got, I'm kind of curious to hear just a little bit more about that, because you said you had started the blog before, and I believe like Twitter was a part of that kind of like journey into Ritholtz, and we've got a lot of young followers. So I kind of like to hear like your perspective and just like story about like starting that personal brand and just like how that transitioned you into where you're at now.
Yeah, so funny, I don't talk about this much, but I actually started anonymous because I was like, hey, I don't know if compliance, I was at a litigation consulting firm, so I didn't know if compliance would be okay with me writing about investment stuff. So I said, start anonymously, had the blog, which was actually on Medium, wasn't on like its own WordPress, its own site, basically. And so I was writing on Medium doing that. I did buy my own custom domain, which I did like, but outside of that, I was doing that for a while. Then I think at 6-7 months in, I kind of went public with it. I mean, so I was a person. And so, oh yeah, you write the Dollars and Data blog, right? I used to just be like a anonymous guy. And then after that, I just kept writing it, got better over time. I think the biggest thing I learned now looking back is like, I wasn't really that good at writing. I don't have like a writing background. I'm not like an English major, I was an economics major, right? I wouldn't say I'm I started as a good writer, but I just wrote, I wrote a post a week, for now it's 288 weeks in a row. You'll get better, right? And you'll learn from your mistakes. You'll figure out how to like kind of become a better writer, and you figure out your voice and everything. So my advice for like younger people is like, don't be discouraged if like it's not working initially. Like you obviously got to take some input. If you have nothing, if like it's really, really bad, then maybe you need to be in something else, if we're being honest. But if you're getting a little bit of traction, it's growing, just, double down and really spend the time. I think everything's about quality in this game. I think more than anything, it's the quality of the content, the quality of the ideas. So that's why I only write once a week. There's people that could do daily stuff, and I just can't put out high quality stuff on the daily level. I have to reduce my frequency in order to keep the quality of a sufficient.
Yeah. I think that's like really great to hear, especially I think another part to that is like knowing what your goal is too. Because some people I think get discouraged by numbers, but at the end of the day, you might not need crazy numbers to be able to build a good business, honestly, from writing. Like I've been writing a blog every single week for coming up on 2 full years of every single week. And, I never have to search for any clients and they all come inbound through that content. Like I don't have a following like you, who knows, maybe one day I could, I have no idea, but it's like, I think some people get so caught up in like, you're not the same as some influencer or some writer that have these crazy numbers, but you might not actually need that large of a following either for your writing to still be impactful.
Yeah, it also depends your niche too. Like who are you writing to exactly? Like, I know there's a financial advisor who's like, I can't remember where he's in. I think I've seen Kentucky or Tennessee or something. He's somewhere in like the Midwest or the South. And he's like a financial advisor just for bass fishermen. And he's like, he made his entire career off that because he knows it well. He writes about the space and he knows people in those networks. So I think people don't realize how niche certain things are. And like, you can just be like, if you're like one of the top people or the top person in a very, small pond, like you can still get a lot of attention. Like, I think I just heard recently about some guy who like, he's like really good at bonsai tree, like he's like maintaining bonsai trees or something. And like, he streams it and he has like a huge following from like, it's just stuff you've never even heard of people are doing and making decent money off of. Right. I'm not saying you're going to be like a billionaire off of that, but like you could probably make a living and enjoy your life and do something you love. So don't discount your niche interest. And so for me, that is like data stuff and like personal finance and investing. Like a lot of people talk about personal finance and investing and they'll use like Excel or something, might use a chart here or there, but like it's like embedded into how I even look at the world, right? And every single post, I generally try to like put data and do all these simulations and things that most people can't do. So that's like my, you don't have to be the top 1% any one thing. If you're in like the top 20% of a few things, you can kind of put those together and create a unique little niche, so to speak.
100%. I totally agree. All right, let's segment into the book. So we're going to do this kind of like almost not really rapid fire, but like we have all these topics, we're going to hit on them and then we'll get to the next one. And all of these are going to be related to like financial planning for millennials. And your book kind of started out in this way anyways. And so one of the first things you talked about, which I thought is really important, I think is really overlooked, is like, why do you think people shouldn't be so heavily focused on investment returns early on in their career? So like in your 20s, why should we be focusing on our career over investment returns?
Because generally people in their 20s just don't have a lot of money invested. So, right. By definition, if you just started working and investing, you don't have a lot of money saved. So your investment returns aren't going to matter that much. You could have $1,000 and you're like, oh, I'm going to get a 20% return next year. That's $200. Like for me, like when I was 23, like that's like 2 nights going out in San Francisco easily, right? You dinner, drinks, Uber home, whatever, that's $100 that you could blow $100 easy. So you could blow your entire investment return in 2 nights. So I think you should focus less on your investment returns early just because, you're not going to have a lot of money invested. So focus on your career, save that money, get that money invested. And once that's a little bit larger, then work on something else.
And I think like even a build off of that too, is like, use that time that there's people who spend hours upon hours a week researching crypto to individual stocks to trading, whatever. Like if you put that time into developing a skill that would grow your income, or even if you just like did some type of side business, like, hey, I really enjoy this. How about instead of using 10 hours a week on like investments, I spend 10 hours a week helping, ghostwrite, or I help like, design websites or something. Like that's going to make far bigger impact long-term than it is how do I maximize my first $5,000 and get 4% higher returns in the market, which you probably honestly won't even do anyways.
Yep. I agree. Completely agree.
So when does like that inflection point change? Like, when do you start to like, hey, now I should spend more time focusing on maximizing investments?
I think there's no exact answer, but what I say in the book, I say there's a save invest continuum. And so everyone's on the continuum, and all you need to know about your life is 2 numbers. The first number is how much could I save in the next year, right? Just a dollar amount. So let's say you could save, $100 a month, 12 months, that's $1,200, right? Or $1,000 a month, 12,000, whatever that is. Let's say that's your first number, $12,000, right? And then the next number is like, okay, how much can my investments return me in the next year? Like, let's say you can expect like, I don't know, a 5% return. Let's say you have 20,000 invested, 5% times 20,000, that's $1,000. You have 12,000 and 1,000, right? So which one's bigger? The 12,000. That means you need to focus more on saving so you can take that money, get it invested so you can raise the other number. That's the goal. Like over time, you should naturally see this. Your saving number will probably keep going up if your income goes up, but you should be seeing the investment number go up. That's the point. And at some point, the investment number is going to get so big that they're going to be roughly the same. That's when you have to kind of spend equal amounts of time. And as you get much older, the investment number should just completely destroy or trump your savings number. Like imagine you're, 65 years old and you've just retired. Now, how much can you save in a year? Basically drops almost to zero, right? Maybe you could save Social Security or something, but let's just assume it's zero. And now your investments are everything, right? So you can see like it's very clear in the extremes where you need to focus. But during the journey, you have to kind of slowly transition and care about both. I'm at the point now where I have to care about both of them. And I think most people have to care about both, but usually the very young don't have to care about investing and the very old don't have to care about savings. And so it's figuring out where you are on the journey.
I think sometimes this is hard too, because like we're talking about not worrying about investments. And it's like at the end of the day, both periods of time, you do still want to care. You're not trying to like throw away the money or do something stupid with it.
Yeah.
But then there's also the hand that like goes hand in hand side of investing, like simple investing does really work. And so like, even if you're at that inflection point, it still doesn't necessarily mean that you need to intermix complexity with simplicity of investing and put significantly more time in hoping to beat the market.
Mm-hmm. I agree. That's generally true. I don't think you necessarily have to spend more time, but I just say you have to be more mindful. I think is the key here. You can't just be like, okay, I'm just going to put it in this. I don't need to care about taxes. I don't need to care about like when you're 22, you can do that. When you're 42, probably not. When you're 62, definitely not, so.
Yeah, totally agree. Okay. So next you talked a little bit about like the flexibility of savings. And I thought this was like really important because I think a lot of people, and you hit on this too, that like people view saving is like static. And like what do you really mean when you start to talk about really like the flexibility of savings and like how savings can change? I think financial advisors sometimes are like, okay, hey, you have to do backdoor Roths this year and max your 401k and then this year taxable dollars. And it's like basically a big red flag or something you should never do is like, hey, maybe this year you're going to have to take it off. Maybe you're going to take a sabbatical, or this year, like the next 2 years, we really aggressively have to save for a house. So now you're going to stop investing. I think people really don't understand that saving and investing for your lifetime isn't something that's going to be static.
Yeah, I think because like our incomes change a lot, especially it's true. Like I think a lot of the personal finance and savings rules probably came out of an era like from like 1950s, 1960s, where like there was a one income household, incomes were pretty stable. There were pensions, like everything was much more stable. In today's world, pensions are gone. It's usually two income households. Usually, for heterosexual couples, the husband and wife work, right? So there's usually two incomes either way, right? And so it's like, what's happening is now we've gone from a state of like much more income stability to much more income variability. And even within people's lives, now a lot of people are getting side hustles and this and that. So because of that, I think there's a lot more income variability out there now. And as a result, like our savings advice hasn't changed to kind of catch up with that. And so I'm kind of just saying, hey, be a little bit more flexible, save what you can.
Yeah, I think that's a very fair point. Okay, so then like you start to talk about this. I think people always talk about like there's a certain dollar amount where like the marginal benefit you get of adding more dollars is really, really low. Like it's like if I have to have this much more work to get these added dollars, it might not be worth it because I hit I don't know if you consider it like your break point or like your basic needs plus some of your wants are met. How does somebody actually find that?
I think for most people, it's actually pretty high to get there. I mean, to be like, it depends what your wage rate is though, right? I think that's the key, right? At some point, like, like for example, if I had to work, 22 hours a day, at some point, by the 22nd hour, I don't care what you're going to pay me because I'm going to feel so miserable the next day having to work another 22 hours that there's just it's not worth living to do that. Now, could I do that for a few days? Yeah. But could I do that for a couple of weeks or a couple months or a year? Probably not, right? That's the difference, right? So I think everything's contextual based on like how people think about their time and how much to work. So I don't really have a great answer to that. I think every person's different and it's going to be based on your individual situation. I think one of the simpler ways to think about it, and this is an idea that came from Eric Jorgensen, which is based on another idea I had, which we don't need to go into right now, but basically his idea was like, you shouldn't do things unless they're going to like move your net worth by about 1%. So if like you're doing like side hustle stuff and you're worth $1 million, let's say, then you shouldn't do anything that's not going to be worth like $10,000, like for the total project, right? If you're worth $100,000, you shouldn't do anything for like less than $1,000, right? Now, obviously, those people that are worth a lot less are willing to work for less, right? So that's the idea. It's like unless you're making bigger moves to your income, you shouldn't be willing to do like these side things or these kind of, I'll call them side hustles for now. So.
Makes sense. And one thing, I really like the chapter on like the 2x like investing rule, because I actually did something similar a few months ago. I had like my weekly 2 Minute Tuesday videos, and to like try and get people just like, I guess just like invested for the first time, like I started doing like a public portfolio with like the public investing app, whatever, and just like anytime I would spend money at a public company, like if I spent $7 at McDonald's, I would just invest $7 at McDonald's on the app and just kind of like show the growth of that over a few months. I was curious like how you came up with that, like if it was like for like maybe a client solution or something like that, or if it was just kind of like a principle or something to like help people get started.
So I don't remember exactly how I came up with it. It's like, where do ideas really come from, right? After I think I just had a tweet and I tweeted it out and I was like, hey, this is something I do sometimes. Like the whole point was to get rid of spending guilt. And I tweeted out, and then I found out later that other people had like, there's a phrase like, if you want something nice, you have to pay for it twice or something. Like there's like different phrases people have that is basically the 2x rule, but no one had put a name on it, right? So some people started calling it the Maggiulli spending rule. I'm like, I don't think that's going to take off. Let's just call it the 2x rule. I don't need to put my name on this stupid thing, right? So I don't know. I think I had a tweet that said something like, the tweet was like, anytime I go to buy, let's say if you go to buy a $400 pair of shoes, I make sure to spend $400 on stocks. But someone thought I wrote socks, and that kind of created like a little viral, like, why are you spending $400 on socks? And I'm like, that's okay. This is a disaster. My whole rule is wasted. So long story short, I don't really know where it came from. I just kind of came up with it one day and I've been using it. And I only do it for like things that I'm like splurging. So my normal things I like to spend money on, no, but if I'm like, oh, I'm going to buy a special pair of dress shoes or something, I don't really spend a lot on clothing. This is like a $7 or $8 like V-neck from Amazon. Like if I'm going to go spend more money on like a nice pair of shoes, I make sure to go invest that extra amount. So if I'm spending 400, another 400, or I donate it, right? There's different ways you can do it to kind of like get rid of the spending guilt. That's the idea. Is I feel like people are so guilted about spending money that we have to get that. And in terms of like clients, like there are clients, like high net worth clients that are, their whole life, they've been so disciplined in saving, and they find that transition into spending really difficult. And so I think for a lot of people, this is a way to be like, okay, not only are you going to spend, but like, you can spend money and you can kind of get rid of the guilt in some other way. So maybe they're not reinvesting the money in that case, but maybe they're like donating money so they can feel better. I don't know. We're just trying to find ways to help clients as well. And I'm not saying that we use this particular rule, but that's just one of many things we can do to kind of help people.
Yeah. And I think it does help reinforce the idea of like, do I actually want this? Because if it's double the cost for you to get it, you'll know for sure, like, is this worth it to me if I have to do both of these things? But I do want to take a step back, and you've talked about guilt with spending a lot. And like, I feel like I didn't really understand how much guilt people have around finances until obviously the last few years of directly working with people. But I feel like one of the most common feelings people have around finances is shame and guilt. And I don't know, like, do you have any other rules or any ways to help people kind of overcome this?
Yeah, I think you have to figure out, and I think this is a very Ramit Sethi type idea, like what's your rich life? And it's basically like figure out what areas of your life are you fulfilled in, like what actually brings you fulfillment. And you may not know if you're 22 years old or 18 years old, you're not going to know whether you like restaurants, you like material goods, you like vacation. Some people are introverts. Like I think there's all this like research out there that's like, oh, people like spending more on experiences than on material goods. Well, most people are extroverts. You look at the data. So like most people on the average result is going to be, let's go do experiences, but like introverts may not feel that way. So I think you have to take in data, think about it, but think about what the data is actually saying. The data is trying to show the average result, right? Or the median person. So you need to say, what actually works for me? What do I care about? Like, and so for you, it might be, oh, I actually like a fancy car. And there's nothing wrong with that. I think we've been shaming people against one type of spending or another because we're looking at the average result and comparing that. So I think what's better is just find out what you like and really enjoy, and then just do those things. But, if you like spending money on everything, then you probably don't really know what you like spending money on. You have to really kind of hammer down into those areas and then just, spend money on those areas, but then you got to cut back in the other areas where you're not spending money. So for me, it's like, I don't spend a ton on clothing. I don't have a car. I've never owned a car. I'm 32. It seems crazy, but I've lived in big cities most of my whole life, or since I've been an adult, that is. And so I don't spend on I don't have a fancy car. I don't have like super, super nice clothing, but I live in New York City and I go out to restaurants, and I do not have any shame about going to a nice restaurant and spending like an exorbitant amount of money on a dinner, because that's my thing. That's what I like. I'm like a foodie. So everyone's got to figure out their thing. And that's, I think, more important. So ultimately your financial life is like really just a journey of like finding yourself. And it kind of gets back to like philosophical, know thyself. This is a question as old as time, right? So you have to know yourself before you can solve for all the other important things in life.
Yeah, I think it's interesting too. Like there are certain things that are like scrutinized spending wise. And it is weird how much I just shame people put on others. Cause like I kind of use the example of, a guy can go buy a 50 or 75,000 or $100,000 car and it's fine. But like a girl wants to go buy a $3,000 purse and they're like shamed as materialistic. Mm-hmm. And it's kind of funny how it is sometimes hard to do and pay for what you want because of, there are the areas where you spend here and people shame you because you spend too much. And then there's other times where you are spending to try to keep up with everybody else. Like it's such a fine line and so hard to determine what you want, but then also make the decision only in line with you and not care how other people are going to interpret what you spend on.
Yeah, it's like you're using your what you derive for identity or status or whatever, and then you're applying it to other people, right? So just because you don't, for example, have a very materialistic way of looking at the world, someone else may have a materialist, or whether that's like, let's say, fashion or something, right? And I think materialistic can even be a derogatory term. I don't think it's necessarily bad, right? So I think it's just about like realizing everyone has different goals, and I think figuring that out. And if that actually brings you fulfillment, that's great. But the question is, does it? And that's, I think, the real question. And so for those people that does bring fulfillment, that's fine. If you like look at nice purses as art or something, that's great, and do that. Like buy those purses, do that stuff. But if you're doing it to like for nefarious purposes or purposes that aren't really like really aligned with you as a person, then I think that's where things go wrong.
Mm-hmm. Okay, so like you started next to talk a little bit about lifestyle creep, and I think like I've written about this a bunch, that lifestyle creep is probably one of the biggest negative factors on millennials' finances. Not that you shouldn't have some lifestyle creep, but I've never thought about it in the way that you talked about it, that as you get new income, the higher your savings rate is, the more that you need to save as new income comes in as well. So can you talk a little bit about kind of that viewpoint of, because I think you use the example of like somebody who saves 10% of their income, when their income goes up, they only have to, with that new income, inflate by like 20%, versus somebody who's already saving 50 has to save more than 50% to then keep up with it.
Yeah. So I think the idea, so the thought experiment we're using here is, imagine you're already like in some sort of steady state equilibrium where you're saving whatever X dollars a month and you're going to hit your retirement goal and everything. So you're in a perfect equilibrium. Of course, this is not realistic, but let's just pretend you're on track. That's all that matters, right? You're on track. And then there's this, what I'm going to call a positive shock. So you get this raise or this bonus or something. And the question is, I was on track before, I just got this extra money. Like, what should I do with it? Right. And so for the people that are saving more, like think about it. Think if you had saved at a rate of, let's say 50% for 10 years, right? And you're on track, everything's good. Everything's going according to plan. If you had saved 50% the rest of your life, you're going to hit your retirement date on goal. You're going to live out your life. Everything's going to be perfect. But now you get this raise, right? And you're saying, okay, I can just save 50% of that. Not true, because what's happened is that extra, if we make one assumption, the one assumption is that you want to keep your spending like consistent throughout your life and in retirement. So let's just make that one assumption. If that's true, and I think that's true for most people, and the data shows it's mostly true. If we assume people want to keep their spending the same, then when you get that raise, that 50, let's say you got a raise of some sort after 10 years, your spending has not only gone up currently, because now you're spending more money because you're spending you're spending 50% of your income, but now you're spending 50% of that raise as well. But now your spending in retirement has gone up, and your first 10 years of savings, you didn't account for that, right? You didn't account for that extra spending later. So because of that, you have to save more. That's the core idea there. It's like, if you're saving at some rate, let's say 50%, then you're spending at some rate, which is 50%. And so that level is going to be going out into the future. But as soon as you get a raise, if you don't account for your new spending going into the future, that's where you get hit up. And so that's why you need to save more than 50% to offset, because you weren't saving more in the past, right? So it's really the effect on spending, right? Now, obviously, if you get a bonus and you do a one-time purchase, that's not going to affect your lifetime spending, then it doesn't matter. But if anything that affects lifetime spending is the issue there.
Okay, so
that's the beauty of data. That's insane.
Yeah.
Never thought about it like that.
Yeah, and I didn't either. There was actually a guy named Nat Eliason who wrote a post on this, and he wrote, I mean, he's a very, very smart guy, but he's not really a financial writer. And so he wrote it in a way that I think like it was good. And I immediately saw like, oh my God, this is like genius in itself. And I was like, this is great. And I was like, I need to dig so much deeper on this and figure out what's the reason for, he was just like running simulations and figuring out like, he just saw this stuff. And I was like, well, why is this? What's really happening here? And as I started digging more, I kind of figured out what was going on here, but really huge props to Nat for that. Cause he was like just the revolutionary who thought of that idea.
I think it's such a powerful point. So if we build off of this in a non-static world where things change, spending changes, income changes, savings change, what do you think is like the best kind of rule of thumb, even though rule of thumbs are the best, of like, hey, I get new money. Should it be that I inflate with half and save with half? Like what would be a good, kind of target for most people? And I do agree that it's different. Like if you're somebody that's not as far along and you basically have no surplus, well, you probably shouldn't inflate your lifestyle much compared to somebody who is 50-50 already.
Yeah. So if like you're in crippling debt, like whether credit card debt or student debt, and then you're like, oh, I can. So the rule I say, which actually it's funny because it matches the 2X rule in some way, it's save 50% of your bonuses and raises. And why is that? Because I ran a simulation across every savings rate and roughly 50% was the right amount for most people. And if you save more than that's even better, but I'm saying if you're saving at least 50%, that's good. So it's easy to remember. It matches the 2X rules. That's the second thing. And it worked in the simulation. But yeah, if you're someone who's like really, really deep in a hole, then yeah, saving at least 50% is to start, but you probably should save more. But once you're on like once you feel like you're on a decent financial track, then I think you can kind of splurge a little. And that's kind of where that 50% marker comes in. And I kind of show how that works and why it makes sense, because it's not intuitive at all. Like we're saying, oh, I'm saving 80% of my income, and if I get a raise, I have to save more than 80% of that raise. Like that makes no sense, right? But once you start to think about like how it affects your spending, that's where you have to save more. So
okay, so next topic, a little bit different, but kind of just follow the book. So I love that you talk about, and I want you to explain like why people shouldn't invest for short-term goals, because I think this is like every person I talk to, like get my emergency fund into an investment. Like I'm saving for a house in 2 years, put in the S&P 500, like everybody. And I totally respect the want to get a return, but there's also a part where the risk is better than what the reward could even really reap you. And I think this is kind of one of those examples. So why should people not invest for short-term goals?
I mean, yeah, they shouldn't put the money into things like stocks. I say, define short term. I think everything in the book there, I talk about, well, what exactly, how far are we talking? Like under 3 years or under 2 years for sure, you should probably be in cash. 2 to 3 years, you may start considering bonds. And then beyond 5 years, you may start considering some sort of stock bond mix, right? And so it's like figuring out where that breaking point is. And the reason is just risk, right? So like, yes, in most periods, if you would just put it all into stocks, that's fine, but then you're going to have to probably save extra. If stocks happen to collapse in a big way, you're going to have to save for extra months to get there. So that's the trade-off. It's really about trade-offs. So like, I'm not saying you have to save in cash. That just says like on average, like you're going to lose a little from inflation. And right now inflation is pretty high. So like the device is not great right now because of how high inflation's been, but over most of history, inflation hasn't been, 7-8% a year. Right. So obviously if that persists, then people are gonna have to probably put it into some other instrument to kind of offset that a little, but there's a lot of factors here. So it's really depending like, okay, how long do you expect to save for? It's going to take you 1 year. It's going to take you 5 years to get to your savings goal, right? That's the first thing. And then from there, okay, how much should you have in cash? Should you transition? There's all sorts of things like that. And I kind of get into that in the book a little bit, but like rule of thumb is under 2 years cash. Maybe 2 to 3 years, you start considering bonds. After 3 years, you definitely want bonds. And then as you kind of get past 5 years, you can start adding stocks and figuring out what the right mix is.
Yeah, and I feel like the two other options here are I bonds. I bonds pretty great rates right now. So like if it's going to be greater than 1 year, less than 5, good option. And I don't know if if you're too into like the crypto world, but stable coins are another potential option. I'm not like telling anybody to go do it, but it is a consideration with 7-8% returns on stable coins too.
Yeah, I think so with the crypto thing, I don't know as much about it. So I think there's unknown risks there, but I think the one thing, if you're going to do a stable coin, you got to do something that's backed by actual dollars and it's known to be backed. So I'm not here to plug any particular one, but you can look up which stable coins we know are backed, which ones say they're backed, but we're not sure, and et cetera. Right. So I think that's what's important, is making sure the assets are actually there in case something were to happen.
Okay. So let's talk a little bit about the 4% rule. So I don't want to hit on it like too much, but how do you feel about let's first have you explain what the 4% rule is for people who don't know, but like, what are your thoughts on it? Do you actually feel like it's a good metric to use?
So, what's his name? William Sharp, who's the founder of the Sharp ratio. It's this mathematical formula that determines, how return per unit risk of an investment. But Sharp, he's a Nobel Prize winning economist. He had this quote where he said, like, retirement is the nastiest, hardest problem in finance, right? And the reason it's so difficult, because there's so many things you have to think about. You have to think about your savings over time. You have to think about your spending in retirement. You have to think about your life expectancy. You have to think about returns, right? There's all these assumptions you have to build in, right? So it's a very complex problem. And the reason why I like the 4% rule, and just to remind the audience, the 4% rule is basically like, however much money you have for retirement, you can pull out on average, and then they did this in the 50-50 portfolio. I think you could use a 60-40 or something. Historically, you could have pulled out 4% a year, and basically every time you would have gotten to 30 years before you ran out of money, like even in the worst case scenarios, right? So they ran this throughout history, and pulling out 4% a year, even adjusting for inflation, changes in inflation, you could have, pulled out 4% a year, adjusted for inflation, and you would have made it to the end of your 30 years without running out of money. So why the 4% rule is great, because it took a very complex calculation of retirement and all these optimization problems, and it just made it very simple. Okay, take this large amount. How much do you have? $1 million? Okay, you can take out 4% a year, 40 grand. Next year, you take out 40 grand plus the inflation adjustment. Next year, you take out that plus another inflation adjustment, right? After 30 years, you should be fine. And so I think that's why the rule is so powerful, because it's a shortcut, right? And so people argued, well, should we not be 4% anymore because bond yields are lower? And well, what about inflation? There's a lot of things there. So yes, some people may have to do less, but I still think it's probably a decent proxy, right? And the question is, okay, you don't like 4%, it's too risky, do 3%. 3% is almost guaranteed to make it there, right?
Yeah.
So that's the things you have to think of.
And the one step I think people don't talk about a lot when they do this is like, you also can factor in Social Security. And I think a lot of young people are just saying Social Security isn't going to exist because that's just what they've heard, even though it really seems unlikely we're all going to pay into Social Security and then we're going to get no benefits in the future. Seems unlikely to me, but if you need $100,000 a year, then it's 100,000 minus what your Social Security benefits are going to be equals the amount you need to be able to pull from a portfolio to figure, and then you multiply that by 25 for anybody that's really trying to figure it out. Okay, cool. Thanks for explaining that. So we talked about bonds a little bit there. Like, how do you see bonds as a part of the portfolio in the future?
So William Bernstein likes to say that, the reason we own bonds isn't for the return on capital, but for the return of capital. And so generally, also, it's funny that we're recording this. Bonds just had one of the worst, 1 month performances in a long, long time. So it's very weird that we're in this very odd time where bonds are doing badly. Inflation's really high, all these things. But generally, over most of history, bonds have been relatively safe. And so it's really a risk thing. It's really about risk. Now, of course, I do believe that if, US yields go negative to the point where you're paying it's crazy to lend to someone. If that were to happen, like it is in many other nations around the world, I think giving up bonds could make sense and moving to cash in those instances and just having cash and stocks. But as long as bonds are still paying a yield, yes, you're going to lose to inflation, but you're going to lose less than if you had, you're holding cash, right? So I think the thing is it's really a risk reduction measure, and that's the key thing. And especially during crashes, there's a flight to safety. Generally, people move to bonds. Of course, there's days where that's not true, but for the most part, bonds go up when stocks fall.
Yeah, I think what's interesting too is bonds are to make you be able to hold on to your portfolio better during downturns, and how that coincides with generations who grow up with crypto, NFTs, and a significant amount of volatility. Because I'm definitely young. I started all equity portfolio. I have an allocation to crypto. I see my portfolio down 30%. I'm excited to buy more. I'm never thinking about selling. And a lot of my clients, I maybe have 20% of my clients that are a little bit more risk averse than that. But most people I've found that are young have a lot larger appetite for risk, where it's a lot of them are I don't even want bonds in my retirement portfolio. It's 40 years away. Why would I want anything that over, a set period of time might have a 2% drag, knowing that I'm not going to sell? So I think it's going to be interesting to be we're in a low rate environment, and also people with higher ability to stomach volatility too.
Yeah, I also think it's going to be interesting to see how well people are at stomaching volatility, just because we've been in one of the strongest bull markets ever for the past decade. We haven't really seen a big downturn other than like 2020, but it's just going to be interesting to see what people's real risk tolerances are over the next couple of years, in my opinion.
Yeah, I would say like ask people today about how they stomach volatility relative to asking them in November 2020. And they're very different because a lot of people, especially young investors, were probably in these tech stocks like Peloton and Tesla and all these stocks, which are now, I mean, I don't know what they're down now, I don't know the exact numbers, but a lot of these tech stocks got wrecked going into 2022 and in early 2022, and they're down 70-80+%, right? And that's, it's like, oh, stomaching volatility is easy when it's just 50%, or maybe it's just like doing own an index, whatever. But now if you've seen your portfolio decline by a bit more than that, it's much tougher. So I think that's the takeaway, is how much volatility can they handle and over what time period. And like, yes, the market's has been going up, which is obviously problematic for that.
Yeah, that's interesting. Okay, so in the book, you talked then a little bit about investing in individual stocks. That you commented on my tweet the other day too, where I put out the stat you had that just 4% of stocks from 1926 to 2016 created all the excess return for stocks above U.S. Treasury bills. Like, that is such an interesting statistic, because I think like it is so common. Every young person I talk to like is trading in individual stocks. I have a new client yesterday. It was like, I invested in this individual stock a year ago. It was at 12,000. Now it's at 1,200. And almost like every client I have come in has like a very similar story, but it seems like nobody actually takes in the information to understand like, hey, maybe I shouldn't be picking stocks. Like, everybody has to learn through failure. But I'm just kind of interested to like, what is your viewpoint on investing in individual stocks? And then like, how does, like, I thought you then made a very interesting point about like how it's really almost impossible or really hard to figure out if you're good or lucky. I thought that was
yeah. So in terms of individual stocks, and you need to learn from failure, I think it's better to learn from failure when you're 22 and you have less money invested. So that's one of the benefits of like, oh, I'm obsessed with investing in 22, and you do some individual stock plays and maybe they don't work out. That's probably the best thing that could happen to you. I know another content creator named Jack Rains is a blogger. He's very good. And he lost $150,000 in a day. He had his accounts for like 100,000 or 60,000, got it up to 400 at one point, and then it was down to like 250 or something. He got out. He's like, I can't do it. That was 150 grand in a day. He's like, what the heck's going on? He's lost more money than that's years of vacations, right? So he just lost all that. So he kind of learned a valuable lesson from that. But guess what? He did that when he was, I don't know, I think he was 23, 24. I don't know how old he is exactly, but that's a valuable lesson. And yes, he learned it, but it's better to learn that early than to do it when you're 50, 60 and have a lot more money at play, right? So the two arguments I make in the book, the financial argument, which I don't know if everyone knows, especially young people may not know, but basically like you look at the data and most stock pickers can't beat benchmarks. They can't beat the market basically over a 3 to 5 year period, but 70-80% of them can't do it. And this is true of like, not just the US markets. You look at international pickers, et cetera, it's much harder. So those are called the SPIVA reports, SPIVA, SPIVA. You can look those up. If you just search SPIVA, you can just look at all those reports and you'll see the data very clear. But that's not even the argument I want to make. I'm not even talking about performance. I'm talking about like what you just said, like, how do you know if you're good at it, right? Most endeavors in life, you'll know relatively quickly whether you have some talent there, whether you could build the talent. I think with stock picking, the issue is the feedback loop is so big. With most things, like, say the examples I give are like, imagine I'm playing basketball. I shoot a ball. Like, I'm either gonna you're gonna know pretty quickly if you're good or not, right? You either accomplish the goal of the ball went in the hoop or it didn't, right? Or a computer program, the computer program ran or it didn't, right? There's a bunch of things you can use to measure performance, right? But with stock picking, you can pick stock, like you and I can pick stocks right now and come back a year from now. And if you beat me, does that necessarily mean you're better or you're lucky? You don't know. And that's the problem. And so I think that's a problem for a lot of stock pickers and young people trying to do this, because there's a lot of people that, as I said, in November 2021 thought they were geniuses all year. And then all of a sudden, all these stocks are down big, or all crypto is down big now this year. And it's like, oh, wow, maybe I wasn't a genius and it was just a rising tide lifting all boats. And so that's the kind of the takeaway there.
Yeah. And I'm curious, a little off topic, like, what was your favorite part of like writing the book? Like, was there a certain chapter that you liked diving more into the data on that? Or also kind of curious like, how the book came about. Like, did you just have so much past content that it kind of just formed into a book, or did you have to do like a lot of other external research to put it all together?
Yeah, so I think writing a book, at least a nonfiction book, is mostly about structure. And so in my case, you're right. I had about half the book is old content that I repurposed, or I kind of Frankenstein monster, took this post and this post on the same thing, kind of put them together and kind of made a greatest hits, so to speak. And a lot of people, like, if you've never heard of me, you're not going to know any of the content. It's all 100% new to you, right? But for most people, even people that have read my work, I've had some people that said, yeah, I've read you a long time. And I was like, how much do you think was old new? And I say, oh, 20 to 30%. These are people who've read me before. So I'm like, actually, it's like 50%. So they just haven't read enough, right? So I think that what I did, I just really said I need to find some sort of structure for it. And I had a bunch of old content, and I kind of just came up with the saving investing structure. The whole book is basically laid out on that save invest continuum, right? So it's like thinking about the saving problems, thinking about the investing problems, and then just digging with data on all of those issues, right? Like, for example, one of the new pieces of content that I've never written on is, should you rent or should you buy a home, right? That's a big question, a big decision for a lot of people. And so I dug into some of the information there, and that's kind of laid out in the book as well. So that's a newer thing though that I've never blogged about, and I don't think I will.
Let's expand on that one, because I was just actually going to ask you about rent versus buy and how you view that decision. Because I literally am always having conversations with people on social media about this. And somebody literally threatened to unfollow me based on what my followers think about renting versus buying today, because they're like, buying is such this great thing. I bought for 210. It's worth 680 now. Like, how is that not a good investment? Like, how do you think through this?
I think right now, obviously, like, because you have to look at most of history, US home prices didn't move that much. The average return after inflation is about 0.6% a year. So it's a small real return. But since like 2000, right, we had the first housing boom and crash, right, which happened in '08, and kind of, I think, house bottom in 2010 or something. But we had that first crash, and now we've had another boom that's even arguably bigger than the first one. Now, obviously, it's not necessarily real estate driven in the same way. So we're seeing this type of stuff happen where, like, US real estate prices are now, pretty high. And so I have no idea if that's sustainable, that's going to keep going. Like, I have no idea the path, right? Like, for example, I have friends that just, they bought a house, 5 years ago. They like, this is so crazy how expensive it is. They sold it. And now they're waiting, like, we hope prices come down so I can buy again. But like, prices may not come down. They may go up more. They may stay flat. I mean, they may kind of just oscillate there. Like, we could have just had a melt up in real estate, and that could have just happened where it's like, now prices are this price, and they're not going to go up much more for the next 5-10 years, but they're now this high, and they're just going to stay this high, until they start going up again at some point. So it's one of those things where, like, timing matters a lot, especially because it's one individual purchase. It's like you're buying a single stock, except it's super expensive. So it's even worse than a single stock, because it's unlikely that someone's gonna be like, you know what, I've been thinking, and I want to put, $80,000 down into my Apple stock. Like, no one thinks like that. That's like a lot of money. It would be like, kind of like, what, you're doing what? Like that. You told your friend. But when you do that with a house, no one blinks an eye, right? So it's a very normal thing. So in terms of thinking about the decision, there's a lot of factors in there, and I don't even think I covered them all in the book. If I really wanted to, there's so much more I could put in there, like things I didn't even think of that I've now read stuff on since. But the main ones I think about, I think it's much more personal than people realize. And it's like, what's your personal life like? Is there stability there? Is your financial life stable? Can you afford it? Right? We get into a little bit of affordability, what a qualified mortgage, there's different ways of thinking about affording it. And just that, the thing about transaction costs, you're going to stay there for at least 10 years. So stability, I think, matters a lot more than people think, because you're going to pay all these transaction costs in and out. And you're like, but Nick, the equity went up, and that's great. Equity went up, but then you have to sell that house and then buy another one. So did you even earn any of that? Unless you're willing to go move to a lower cost area. And I think most people generally aren't doing that. Maybe retirees can do that, but most people, like our age millennials, you buy a house, then it goes up a ton. Okay, you're going to sell it, but where are you going to move now? You're probably going to stay in the same area, right? Unless you're like, oh, I'm going to move to a much cheaper area. That's the only time you're going to really arb that. Otherwise, you're not. And so that's equity you can't eat, right? You can't eat that equity, unfortunately. So,
and now you combine that too with a rising interest rate environment. And hey, I sold my house for a great amount, but now to get the same house or to have the same monthly payment, I would actually have to cut the house I would buy by a decent amount. So, like, sure, it's great on paper that you have this return, but you're just moving into the very similar situation where now you're going to have a higher cost to have the same thing.
Yeah, exactly. I agree with that.
Okay, so now I guess to switch a little bit, what are the best ways for investors to mitigate risk?
So I think, this question depends on what type of risk we're talking about, but generally I think, planning, preparing, diversification, that's the second one. Those are probably the two big ones I think about for mitigating risk, and just being flexible, like having optionality helps a lot as well, right? If you can, like, make financial decisions where you're kind of in control of what you're doing, and like you can wait on things or move things around, I think being flexible is really important, because if you have to do something at a certain time, for example, like, oh, I know I have to if you're saving for a house and you put it in stocks, like the issue with doing something like that is because, oh, I know I have to sell it now. I'm very inflexible on that. Or I have to pay for a wedding. Like, like the wedding's not, you're not going to move the wedding, right? Because it's stock. Oh, the stock market crash, you have to move the wedding. That's generally not going to happen. So now you're a forced seller, right? You have to sell, right? So anytime you have fixed things you have to do, and they're in risky investments, that's where you can kind of get into trouble. So I would say like diversify, and, kind of try to plan your best. I mean, obviously it's impossible to know the future, but having flexibility helps a lot there as well. So.
Okay. That makes a lot of sense. So then in the book, you started to talk a little bit about like why saving to buy the dip is not actually the best option. Can you expand on like why dollar cost averaging is better than holding cash and waiting for a market downturn?
Yeah, idea is very simple, right? So if you assume that, most, investments of these sorts of these income producing assets, are going to grow over time, they're going to move up and to the right, as they say, then the whole idea of buying the dip is you're like, okay, I'm going to wait until I get a dip of some amount, let's say 10%, 20%, whatever, you have some threshold amount. The issue is by the time that dip usually occurs, or a bigger dip occurs, because they're so rare, the price you buy at is higher than what you could have bought at originally. So imagine it's at 100 and then it goes to 200. And you're like, okay, I'm going to buy after a 20% dip. And so it goes from 200 to 160. That's a 20% dip, right? 20% of 200 is 40. So 200 minus 40 is 160. So you buy at 160 thinking you got a deal, and you got a deal on the current price, but relative to when you could have bought at 100, you just paid 60% more, for the same asset. So that's the type of stuff that happens. And I have a good example of this. When I started, I actually wrote a blog post called Just Keep Buying literally 5 years ago to the day before the book's coming out next week. Right. So just a weird coincidence anyway. So it became the intro in some ways. I made some changes, but I remember people then saying, oh, market's too overvalued. Like, you're saying this now, you'll regret this, blog post, whatever. I had a couple comments, things like that. But if you had bought then, let's say you hadn't bought, I'm sorry, let's say you just saved cash, like I'm waiting for a dip, right? Because the market's overvalued. And you waited until March 23rd, 2020, which was the exact bottom, the perfect time to buy. Assume you had perfect foresight, you could just wait until that day to buy, right? Even if you had waited till that exact day, holding cash the whole time and just bought then, you would have bought at prices 7% higher than what you could have got in early 2017, right? So it's just kind of funny that like, even if I give you that perfect foresight, you got the perfect dip, 33% down. That's a pretty big dip. Those are rare, right? We've only had a handful of those, in the last couple decades, right? Even if you got that dip, you still would have bought at prices higher than when you would have made fun of my article back in 2017, right? So that's probably the easiest way to explain it. Most of the time when you're buying the dip, you're probably buying at a higher price than you could have got it originally. Yeah. So just get your money invested sooner.
Yeah, I definitely think the move is a dollar cost average in, but I think like when dips happen, you might have the opportunity to say like, okay, hey, I have a 6-month emergency fund. Do I maybe move it down to 3 months to get a little cash in and then build back some of those options there? Because I still think there is an advantage at times of like, hey, market's low, let's buy, but you shouldn't not use the money when you have it to get there. It just might be, oh, good opportunity. For me, like when that happened in March 2020, I moved out of the 10% bonds I had, reallocated to stocks at a lower period of time. And so you do have options to still be able to get in at the dip without holding for the dip.
Yeah. So you can do rebalancing things. I've done that as well. I sold actually by chance, and this is very wild, but I did sell all my bonds on the March 23rd, 2020 and rotate into stocks. It was complete luck. But you can do stuff like that. I don't necessarily recommend that with an emergency fund. I think it's a little scary because if the dip kept dipping and something, you lost your job and now it's like, wow, I took my emergency and I just threw it out. But of course, those that did do that did fine. Yeah. So it's a little risky to do that, but you have to think. So I think what I say in chapter 17, because like you're saying, well, in chapter 17, I talk about why buying the dip is such a great idea, conditional on like if you're already in the dip, then yes, if you happen to get an influx of cash, let's say you happen to sell a business right as the market's dipping, oh my gosh, that's like a miracle, right? Buy the dip, right? But you shouldn't expect the dip. And that's very different, right? Waiting for the dip is bad, but if the dip comes, buying it just because by chance you had extra cash, then yes, it makes sense to do it. But it's about thinking about how you do that. And that's what's important, right?
Yeah. So. No, that's actually really helpful. Okay. 2 last questions. So one of them, you started to go into different types of accounts. So with future tax rates being so uncertain, how do you really think through Roth versus traditional?
I think it's a really tough question because I think tax is one of the most difficult things to talk about in investing because it's so personal. So like if you're married versus single, that's one thing, which state you live in, there's all these like things you have to account for optimization purposes. So it's very difficult. And then yes, there's the timing factor of like for example, everyone was like, oh, you got to do Roth because future tax rates are going to go up. So you should pay a lower tax now instead of paying a higher tax later. I thought about that in 2012. I did Roth very early on. Next thing you know, the 2017, Tax Cuts and Jobs Act, whatever it's called, they lowered tax rates. I'm like, what? I would not have expected that. So I have no clue what's going to happen to future taxes. So what I like to think about is, I think honestly, like, I generally prefer the pre-tax because has a little bit more, I think, flexibility. And technically, anyone who's doing a Roth, if you have an employer that's matching you, they are matching pre-tax. So you're actually doing both. So I think a lot of times, like, doing both actually makes the most sense, because you're going to have, like, a little bit of flexibility in which money you pull from which bucket, etc. At the same time, I just like doing pre-tax because, like, I've been living in high income tax states. So for me, that makes sense. But I don't think there's a right answer. And I talk about in this circumstance, it makes sense to do Roth. In this circumstance, it makes sense to do pre-tax, etc. And the idea is flexibility. And so I think the traditional 401k, the standard 401k, pre-tax versus Roth, which is like the post-income tax. I think that one is a little bit more flexible because you can play tax games. For example, let's say you're going to take a sabbatical next year, you're going to have no income. Oh, if your pre-tax 401k doesn't have a lot, you can pull that, you can kind of convert that year, and your tax rate's going to be low because you have no income. So you can play tax games that way. I know people that went to business school and they did that, and guess what? They had no income. So for that year, they paid a lower tax rate than they would have paid during their working years than if they'd done Roth, right? So it's all about thinking about that. And I think the traditional 401k gives a little more flexibility there, but honestly, doing both isn't a bad idea either.
Yeah. And I think it becomes hard too, because it's like, okay, I'm 30 years old, I make 150, I live off of 100. Like, okay, well, in the future, like, I estimate to live off of pretty similar in retirement. So I'm going to pay tax today. But then all of a sudden it's like, well, what happens if 10 years from now, your career takes off? Now you're making multiple $1 million a year. And it's like, well, now in retirement, I'm going to be in a very high tax bracket just because I'm able to save so much. And now my lifestyle is inflated. So there's all those unknown variables. Plus, like, what if you continue to make a ton of money and now your lifestyle inflates a lot? Like, I mean, I think it's just such a hard decision where everybody kind of, at the end of the day, it probably isn't that much of an impact, unless you're like, hey, I'm in the 37% tax bracket today and I'm going to be in 12 or 22 in retirement. Like, that's a little bit easier versus I'm 22 or 24. It's really hard to decide and know.
At the end of the day, just keep buying.
Yeah. Branding, I'll send you $20 after the show. Okay.
Okay. So last question is, why should people not max out their 401k first?
So just to be clear, I think everyone should get the employer match. Always, everyone should get the employer match.
100% return, take it.
Yeah, it's undebatable. So just for the record, employer match, I agree with that. Above the employer match, I think you have to think about it a lot. And there are people where it makes sense to do it. If you're in a high tax state now, high income, you think you're going to be in a low tax state later. Let's say if you're in New York or California now, you're going to move to Florida, that with certainty, probably makes sense to max, get those after tax dollars in. But for a lot of people, it may not make sense depending on the fees in their 401k, depending on, because I looked at the data and basically, like, the tax gain you get from, like, the tax alpha from, like, putting it in a Roth 401k versus just keeping that money post-tax and just putting it in a taxable brokerage account is only about 0.7% a year. It's like 0.73%. So 70 bips, so to speak. Right. And so that it's a small amount of money. And then that doesn't even include any difference in fee. That assumes you can get, like, the same fees in a brokerage as you could in your 401k. And there's, like, all in fees. There's a bunch of fees in there you may not know about. And there are a lot of plans out there that, like, there are fees you don't even know, not even the fund fees. I mean, just the fees for, like, just the 401k plan itself, where it's very difficult to know all those fees. And so you have to, like, really dig through the documents and you'll be like, wow, we're paying this much. And so all in, you end up, if you're getting 70 bips and you're paying, 50 bips and 0.5% in fees, you're only getting 0.2 bips to lock up your capital to 59.5. And I'm like, is that worth it? Is that tax alpha worth it? And I think for a lot of people, it's not. So I'm not saying that no one should max out their 401k. I just think it's such universal advice. No one ran the data to say, like, does this actually make sense for me? So I'm just getting people to just rethink. Let's go back to first principles. Does this actually make sense for my situation with my goals and all this stuff? And I think I regret maxing, and I should have just gone to the match. And I wish I had more money outside that, because I don't want to pull money out of those and start getting, I don't even want to mess with any of that stuff. Right. I don't like, oh, well, you can take out 50 grand for a house payment. Like, I understand that, but that, to me, that is retirement money. So for my mental stability and, like, my bucketing, that's retirement money. I do not touch it, and I have to stay that way. Otherwise I might touch it. Right. So that's my takeaway there.
Yeah, I think it's really, like, in the hierarchy, it's really close to the bottom, like HSA, Roth, taxable dollars, 401k match, like, all of those things come first. And I mean, you want to use the tax advantages, but the flexibility and hey, I want to take a sabbatical, or hey, I want to stop working at 50 because I have enough money. I think it's a lot more powerful than getting 0.7% differences from what your math says.
Yeah. And obviously, that doesn't include any sort of difference in fees. So I think most people are probably, after their fees, are probably getting somewhere to like 0.4%, 0.3 to 0.4%, if I had to guess, right? Because the average all in 401k fee is like 45 bips, right? So you take 0.73 minus 0.45, you're looking at like 30 to 40 bips, which is like not a lot, right? Considering like you have to lock up your capital to 59 and a half. So
yeah, exactly. Well, hey man, I really appreciate you coming on. I'm actually pretty impressed that you were able to, I know you wrote the book, but on the fly answer every question, know what chapter it's from, exactly what you talked about. I really enjoyed the book. Thanks for sending it over. We're going to continue to share with other people. We'll leave it in the show notes. But again, we really appreciate you hopping on our podcast and being able to share a little bit about what you're creating. I know you've inspired both of us, and we've kind of followed and learned a lot from your writing, and it definitely has helped shape who I am as a content creator as well. So thanks for everything that you do. And thanks again for coming on to the podcast.
Of course, appreciate it. Thank you guys for having me on, and thanks for asking some very detailed questions, because I love how everyone's asking different questions. I could tell you guys really dug into the details. You want to get the the truth out there, and I love that. So I really appreciate you guys having me on. Thank you.
Yeah. Well, thanks, man, and thanks everybody for listening. Please again rate, subscribe, and we'll see you back next week.